Disclaimer.
While retail investors are celebrating $110 silver, the most powerful rooms in Washington are in a state of silent panic. On Friday, the New York Fed bypassed official channels to conduct rate checks with currency dealers. They aren't just watching a commodity rally, they are watching the collapse of the dollar index to 97.11, the lowest point in 4 months. This isn't just about inflation anymore. It's about an independence crisis. With Jerome Powell currently under a DOJ criminal investigation and rumors of an immediate replacement being announced during tomorrow's Fed meeting, the safe haven trade has officially turned into a flight from fiat. Silver didn't just hit $110, it's being used as an escape hatch. If you're only looking at the price, you're missing the trap. To survive the next 48 hours, you need to understand why 75% of silver supply is physically incapable of responding to this price, and why the 11% premium in Shanghai proves that the West is losing its grip on the market. Before the Fed attempts to freeze the exit this Wednesday, let's look at the hard data they don't want you to calculate. The Department of Justice, his criminal investigation into Federal Reserve Chair Jerome Powell over building renovation costs, sounds almost comically trivial on the surface, like auditing someone's office furniture budget. But global markets aren't laughing. They're dumping dollars at a pace we haven't seen since the financial crisis of 2008. Think about what this really means for a moment. The Federal Reserve is supposed to operate independently from political pressure. That independence is the bedrock, the absolute foundation of monetary credibility worldwide. When investors in Tokyo, London, Frankfurt, and Shanghai look at where to park their wealth, they need to believe our central bank makes decisions based on economic data, not political vengeance or presidential whims. The moment that independence comes into question, every foreign government and every sovereign wealth fund manager has to ask themselves a terrifying question. Is the dollar still a safe place to store our nation's wealth? Here's where it gets even more concerning for anyone holding dollars in their savings account, their retirement fund, or their wallet. According to data from the Federal Reserve's own trading desk, foreign central banks reduced their treasury holdings by more than $40 billion in just the last 2 weeks. $40 billion. These aren't retail investors panic selling. These are the finance ministers and central bank governors of entire nations quietly moving their reserves out of our debt and into something they can physically hold. That something is silver and gold, but especially silver. Pop quiz? When was the last time you saw silver outperform gold by this magnitude in a single month? The answer is never in the modern era. Gold, yes, traditionally serves as the crisis hedge, the monetary metal that central banks hoard in their vaults. But silver? Silver has always been gold's more volatile, industrially focused younger sibling. Until now. The gold to silver ratio, the number that tells us how many ounces of silver it takes to buy 1 ounce of gold, just crashed to 50 to 1. For decades, this ratio has averaged somewhere between 60 and 80 to 1. During extreme silver shortages, it might touch 55. But 50? That's a market screaming that silver is being revalued in real time as a monetary asset, not just an industrial commodity. Now layer in what President Trump announced just 48 hours ago. Fresh tariffs against South Korea, targeting their electronics and automotive exports. South Korea, one of our crucial allies in the Pacific, one of the largest manufacturers of the semiconductors that power our modern economy. These aren't small symbolic tariffs for show. These are substantial trade barriers that threaten to disrupt supply chains for everything from your smartphone to your electric vehicle. Have you noticed what happens every single time trade tensions escalate? Capital flows out of equities, out of bonds, out of currencies, and into tangible assets that can't be printed, can't be tariffed, and can't be politically manipulated. And right now, with tensions rising not just with South Korea, but with China, with Europe, with our traditional trading partners across the globe, the rush into physical metals isn't a trickle, it's a stampede. According to the World Silver Institute's latest data, industrial demand for silver in 2025 reached an all-time record of 530 million ounces, driven primarily by solar panel manufacturing and EV production. But here's what your financial advisor probably hasn't told you. That industrial demand number does not account for investment demand. That doesn't include the millions of retail investors across Asia, Europe, and yes, America, who are buying physical silver bars and coins as a hedge against exactly the kind of currency instability we're witnessing right now. Let me paint you a scenario that might hit closer to home. Imagine you're planning a vacation to Europe this summer. Last year at this time, you could exchange $1 for roughly 1.10 euros, making that Paris vacation relatively affordable. Today, with the dollar index at 97 and falling, you're looking at exchange rates that make everything from your hotel to your baguette significantly more expensive. That's not just bad luck or market noise. That's the global economy telling you that our currency is losing purchasing power in real time. But here's what should really grab our attention. This isn't just affecting vacation budgets or import prices. This is affecting the core structure of how the world does business. For the last 80 years since the Bretton Woods Agreement after World War II, the dollar has been the world's reserve currency. That means countries hold dollars to facilitate international trade. That means commodities like oil get priced in dollars. That means our government can borrow at lower rates because there's constant global demand for our bonds. What happens when that demand evaporates? What happens when the structural bid underneath our currency, the assumption that everyone everywhere needs dollars to function, suddenly comes into question? You get exactly what we're seeing this morning, a flight from fiat currency into physical assets that have held value for thousands of years. The International Monetary Fund published a report just last month highlighting the increasing diversification of global reserve holdings away from the dollar. Central banks are now holding the lowest percentage of dollar reserves in 25 years, shifting instead into euros, yen, yuan, and crucially, precious metals. This isn't conspiracy theory. This is official policy documented by the world's premier financial institutions. So when you see silver hitting $110, don't think of it as just a commodity price spike. Think of it as a vote of no confidence in business as usual. Think of it as millions of investors worldwide from Shanghai to Zurich to New York, simultaneously deciding that physical metal in their possession is safer than a promise from a government that appears to be politicizing its most critical financial institution. This isn't just a rally in some obscure corner of the commodities market. This is what a flight from fiat looks like in real time. This is what happens when the perceived stability of our monetary system, the independence of our Federal Reserve, the strength of our currency, the reliability of our government bonds, all come under simultaneous pressure from political interference and escalating trade wars. And here's the part that should concern every single American with a savings account, a retirement fund, or a mortgage. We're just getting started. The constitutional crisis between the DOJ and the Fed isn't resolved. The tariff battles are escalating, not de-escalating. The global reallocation of reserves away from dollars is accelerating, not slowing down. But the real story isn't the price you see on your screen. The real story is buried in the vaults, in the export licenses, in the premium spreads between New York and Shanghai. The real story is why the silver CA ain't come to market no matter how high the price goes, and why that matters more than any headline you'll read this week. Let's talk about something most investors never see, the actual metal sitting in the vaults that back the paper contracts trading on our exchanges. Because here's what happened earlier this month that should terrify anyone holding silver futures or ETFs without understanding what they actually own. On January 14th, COMEX registered vaults experienced the largest single-day withdrawal in the exchange's history. Nearly 2 million ounces of physical silver walked out the door in one day. Not transferred between vaults, not moved from registered to eligible status, gone. Delivered to entities who wanted the actual metal in their possession, consequences be damned. According to the CME Group's official warehouse stocks report, this drawdown left just 127 million ounces in the registered category, the pool of metal that was actually available to settle futures contracts. Now, if you're not familiar with how commodity exchanges work, let me explain why this number should make your blood run cold. At any given moment, there are roughly 600 million ounces of silver futures contracts outstanding on COMEX, 600 million ounces of paper claims on 127 million ounces of physical metal. Do the math with me for a second. That's a leverage ratio of nearly 5 to 1. For every actual ounce of silver sitting in a vault with a registered warrant attached to it, there are 5 paper contracts claiming ownership of that same ounce. This works perfectly fine as long as everyone agrees to keep playing the paper game. This works perfectly fine as long as contract holders are content to roll their positions forward month after month, accepting cash settlements instead of demanding physical delivery. But what happens when that gentleman's agreement breaks down? What happens when holders of those paper contracts start saying, "No, I don't want your cash equivalent, I want the actual metal you promised me"? You get exactly what we're seeing right now. A price that disconnects from traditional supply-demand models because the market is suddenly pricing in the risk that the paper system itself might not be able to deliver on its promises. Think about this from the perspective of a large institutional investor or a sovereign wealth fund. You're watching the dollar collapse, you're watching political interference in our central bank, you're watching trade wars escalate. Do you really want to own a piece of paper that says you own silver? Or do you want the actual metal sitting in your vault in Zurich or Singapore? The answer is obvious. And that's exactly what's driving the stampede out of COMEX registered inventory. According to data from the World Gold Council, physical precious metals demand in the fourth quarter of 2025 reached the highest level since the global financial crisis. But here's the critical distinction. This isn't jewelry demand or industrial demand. This is investment demand, bars, coins, and allocated vault storage. This is wealth preservation, not manufacturing input. Now layer in what China just did to cement their control over the physical market. On January 1st, 2026, the Chinese government implemented a new silver export licensing regime that fundamentally changed the rules of global supply. Before this policy, Chinese refiners could export silver relatively freely, responding to price signals and demand from Western manufacturers. Those days are over. Under the new system, only 44 authorized firms can export refined silver, and each shipment requires government approval through a licensing process that can take weeks. The official justification from Beijing is strategic resource management and environmental protection. The real reason? China is now treating silver the same way it treats rare earth elements, as a strategic asset that gives them leverage over Western technology supply chains. Let me put this in perspective for you. China produces roughly 17% of the world's mined silver, but more importantly, China refines nearly 40% of global silver supply. When ore comes out of the ground in Peru, Mexico, or Australia, much of it gets shipped to Chinese refineries for processing before it enters the market as investment-grade bars, or gets fabricated into industrial components. By controlling the export of refined silver, China is not just controlling their own production, they're creating a choke point for a massive portion of global supply. The impact is already visible in delivery delays and manufacturer complaints. According to a report from the Silver Institute published last week, Western electronics manufacturers are experiencing 10 to 15% delays in silver deliveries for circuit boards and photovoltaic cells. Electric vehicle manufacturers, who need silver for battery connections and power electronics, are being told that lead times have doubled. Solar panel producers are scrambling to secure supply commitments that used to be routine. And here's what makes this particularly devastating. 75% of silver mined each year comes as a byproduct of mining other metals: copper, lead, zinc, gold. You can't just mine more silver in response to higher prices because silver is not the primary target. The mine economics are driven by copper or gold prices, not silver. So even with silver at $110, the supply response isn't a simple matter of opening new silver mines. The supply response is constrained by the economics of completely different commodities and the refining capacity controlled increasingly by one country. This is what we mean when we say 75% of supply is physically incapable of responding to this price. Mining companies can't retool their operations overnight. Refineries can't appear out of thin air. And most critically, China now controls the valve that determines how much refined silver actually reaches Western markets, regardless of what the price signal says. But if you want the smoking gun, the absolute proof that the paper price in New York has lost its connection to physical reality, look at what's happening right now in Shanghai and Mumbai. While COMEX silver is trading at $110, physical metal on the Shanghai Gold Exchange is trading at $121. That's an 11% premium, or $11 per ounce for the exact same metal. In Mumbai, on the Multi-Commodity Exchange of India, the premium is even higher, nearly 13% over the New York paper price. These aren't minor divergences or temporary arbitrage opportunities. These are sustained, persistent premiums that have been widening for 3 consecutive weeks. And they tell you everything you need to know about who controls the physical market and who has been left holding paper promises. Think about what this premium spread really means. In a normal functioning market with free capital flows and efficient logistics, an 11% price difference would attract immediate arbitrage. Traders would buy silver in New York, ship it to Shanghai, and pocket the difference. That arbitrage would close the gap within days, if not hours. But that's not happening. The premium persists because the physical metal isn't flowing from west to east anymore. It's locked up in China's export licensing regime. It is stuck in COMEX vaults where paper holders are afraid to stand for delivery and stress the system. It's trapped in the logistical reality that you can't move millions of ounces of metal across borders in a matter of days, especially when the Chinese government can slow or stop those shipments with a stroke of a bureaucratic pen. According to the Bank for International Settlements, cross-border gold and silver flows have declined by 32% year over year, the largest drop since trade data has been systematically tracked. This isn't a natural market evolution. This is the deliberate fragmentation of the global precious metals market into Eastern physical and Western paper spheres, with the Eastern sphere increasingly setting the real price for anyone who needs actual metal. Have you noticed what's happening to your electronics prices lately? Your smartphone, your laptop, your solar panels, anything with significant silver content? The manufacturers are absorbing these higher input costs for now, but that can't last forever. When the premium for physical silver in Asia stays at 10 to 15% above Western paper prices for months, not weeks, those costs get passed along to you. That's not inflation from money printing. That's inflation from genuine supply constraints and geopolitical fragmentation. Here's what this means for the average American trying to protect their wealth. If you own paper silver, ETFs, futures contracts, even some forms of allocated storage that don't give you direct possession, You're exposed to a risk that didn't exist 6 months ago. You're exposed to the risk that in a real crisis, when you want to convert that paper claim into physical metal you can actually hold, the system simply won't be able to deliver. Not because the metal doesn't exist somewhere, but because it exists in places that are no longer allowing it to flow freely to where you need it. The smart money has already figured this out. That's why vault withdrawals are accelerating. That's why premiums on physical coins and bars from your local dealer are running 8 to 12% over spot price, when they used to run 2 to 3%. That's why wealthy investors are paying to ship physical silver to private vaults in Switzerland, Singapore, and Dubai, because they understand that possession is the only form of ownership that matters when the paper system is under stress. The Federal Reserve and the Treasury Department are watching this unfold with growing alarm. They can't admit publicly that they've lost control of precious metals pricing to Eastern exchanges and Chinese export policy. They can't acknowledge that the dollar's declining reserve status is manifesting in citizens and institutions desperately converting paper dollars into physical metal. But their actions speak louder than their press releases. That rate, check the New York Fed conducted with currency dealers on Friday. That wasn't routine market monitoring. That was a panic probe to understand how much stress the dollar is under and whether intervention is needed. The fact that they bypassed normal channels tells you they didn't want this inquiry showing up in official records that might alarm the public or give ammunition to dollar skeptics. We're watching the architecture of the post-World War II financial system crack in real time. For 80 years, the United States set global prices for strategic commodities through our exchanges. For 80 years, the dollar's reserve status meant that everyone needed our currency and played by our rules. Those assumptions are breaking down, and silver is the canary in the coal mine, showing us how fast the transition is happening. Now let's talk about where this is actually going. Because the $110 price you're seeing right now isn't the destination. It's a rest stop on a much longer journey. And if you understand the mathematical relationships that have governed precious metals for centuries, you can see exactly where we're headed next. Gold is currently trading at $5,100 per ounce, an all-time record that has shattered every previous projection from mainstream analysts. But here's what most people don't understand about the relationship between gold and silver. They don't move independently. They're linked by a ratio that is proven remarkably consistent throughout human history, even as the absolute prices fluctuate wildly. The gold to silver ratio, how many ounces of silver it takes to equal 1 ounce of gold, currently sits at roughly 50 to 1, with silver at 110 and gold at 5,100. But here's the critical insight that sophisticated precious metals investors have understood for decades. This ratio does not stay static during monetary crises. When fear of currency debasement takes hold, when central bank independence comes into question, when the paper monetary system shows signs of stress, this ratio compresses. Silver catches up to gold. And historically, that compression targets a range between 40 to 1 and 50 to 1. We're at the upper end of that range right now. But if gold continues its march higher, and with the Fed meeting on Wednesday threatening to destabilize the dollar even further, there's every reason to believe it will, silver has to follow. Not just to keep pace with inflation or industrial demand, but to maintain its historical monetary relationship with gold. Do the math with me. If the gold to silver ratio compresses to 40 to 1, which is the historical average during acute monetary crises like the one we're experiencing right now, and gold holds at $5,100, where does that put silver? 5,100 divided by 40 equals $127.50 per ounce, $127.50. That's not a wild speculation or a moonshot prediction from some fringe analyst. That's basic mathematical gravity asserting itself based on centuries of precedent. But here's where it gets even more interesting and potentially more profitable for those positioned correctly. On February 1st, just 5 days from now, European tariffs on American exports take effect. 10% across the board on manufacturing goods, technology products, and agricultural commodities. The European Union, our largest trading partner, is responding to our tariffs on their automotive sector with reciprocal measures that will hammer American exporters and further weaken the dollar. What happens to gold when the dollar weakens further? It goes up. It's a mathematical certainty because gold is priced in dollars globally. When the dollar loses 5% of its value, gold priced in dollars rises proportionally. And when gold rises, silver follows. But with a multiplier effect because of the ratio compression we just discussed. So if European tariffs push the dollar down another few percentage points and gold moves to 5,300 or 5,500, suddenly that 127.50 silver target starts looking conservative. According to Forex strategists at major European banks, the ones who actually move billions in currency markets, not the ones giving sound bites on financial television, the dollar could test 95 on the dollar index if tariff tensions escalate as expected. 95. That's another 2.1% decline from current levels. That's the kind of move that could push gold to 5,300 in silver, maintaining its ratio relationship to 132.50. But before you rush out to lever up on silver futures or max out your credit card buying coins from your local dealer, you need to understand the trap that's about to be sprung. Because the exchange that facilitates all this paper trading, the CME group that operates COMEX, has a playbook they follow every single time a commodity makes a parabolic move like we're witnessing right now. They raise margin requirements dramatically, without warning. Here's how this works and why it's about to create a violent shakeout that will scare away everyone who does not understand what's really happening. When silver gains 52% in a single month, which is exactly what just happened in January 2026, the exchange views this as excessive volatility that threatens the financial stability of the clearing system. Remember, for every winner in a futures contract, there's a loser. When silver moves this violently, the losers, the short sellers, the hedgers who got caught on the wrong side, face massive margin calls. If they can't meet those calls, the exchange and the clearinghouse are on the hook. To protect themselves, the CME raises the margin requirement. Instead of needing $10,000 to control a futures contract worth $60,000 of silver, suddenly you need $25,000 or $30,000. That forces leveraged speculators to either deposit more cash or close their positions. And when thousands of retail traders and small hedge funds are forced to liquidate at the same time, you get a cascade. You get a violent, gut-wrenching sell-off that can shave $10 to $15 off the silver price in a matter of hours. This isn't speculation. This is documented historical pattern. In April 2011, when silver hit $49, the CME raised margins 5 times in 8 days. Silver crashed from 49 to 33 in 72 hours, a 33% bloodbath that wiped out retail investors who thought they were riding the wave of a lifetime. In February 2021, when the Wall Street bets crowd tried to squeeze silver above $30, margins went up 40% in one weekend. Silver dropped back to 25 within a week. You need to be prepared for this. You need to understand that when silver hits 120 or 125, right as it approaches that mathematical target we calculated, the exchange is going to pull this lever. They have to. It's not a conspiracy against retail investors, though it certainly feels that way. It's a risk management protocol designed to prevent the entire derivatives market from imploding when volatility spikes. So here's what you should expect in the next 2 to 3 weeks. Silver pushes toward 125 or 130, as the gold ratio and dollar weakness create irresistible upward momentum. Then the CME announces a margin increase, probably 50 to 75% higher than current levels. Leveraged traders panic and sell. Silver drops $10 to $15 in a brutal 2 or 3 day washout that makes headlines and triggers silver bubble burst. Articles across mainstream financial media. And that's when the real opportunity emerges. Because here's what those articles won't tell you. The physical buyers didn't go anywhere. The sovereign wealth funds moving reserves out of dollars didn't change their mind. The Chinese export restrictions didn't lift. The COMEX registered inventory didn't magically refill. All the structural factors driving this crisis remain intact. The only thing that changed is that weak hands got shaken out of leveraged paper positions. That dip, that manufactured panic washout, is the buying opportunity for physical metal or for positions you plan to hold through the next phase of this crisis. Because make no mistake, we're nowhere near the end game. We're in the second inning of a 9-inning game. Which brings us to Wednesday. The Federal Reserve meeting that was supposed to be a routine policy statement about interest rates has become something far more consequential. With Jerome Powell under criminal investigation and rumors swirling about his replacement, this isn't just about whether rates go up or down by a quarter point. This is a constitutional stress test of whether our central bank can function independently or whether it becomes an arm of political power, subject to executive branch intimidation. If Powell resigns, or if he's forced out, the signal to global markets is unmistakable. The Federal Reserve is no longer independent. The institution that has anchored global monetary policy since World War II, the institution that foreign governments trusted to make decisions based on economic fundamentals rather than political expediency, that institution no longer exists. And if that happens, the dollar's support at 95 on the index, the level that has held during previous crises, vanishes. What we're experiencing right now with silver at 110 would look like a preview. A currency that loses the confidence of its reserve holders enters free fall, not decline. We're talking about dollar index potentially testing 90 or below, gold pushing 6,000, and silver maintaining that 40-to-1 ratio, reaching 150. This isn't fear-mongering. This is pattern recognition based on how monetary crises unfold when reserve currencies lose their status. The British pound went through this after World War II. The Spanish real went through this in the 17th century. The process is slow at first, then becomes disastrously fast. And the people who survive with their wealth intact are the ones who saw the writing on the wall and positioned themselves in assets that can't be printed, can't be politically manipulated, and maintain value across regime changes. Your dollars in your bank account are losing purchasing power every single day this crisis intensifies. Your stocks are denominated in a currency that's in structural decline. Your bonds are claims on a government that's politicizing its central bank. But an ounce of silver is an ounce of silver whether the dollar is worth 100 on the index or 90 or 80. And that's why, despite the volatility, despite the scary price swings, despite the margin hikes, and the media panic, the smartest money in the world keeps buying physical metal. So here's what you need to do right now, today, before Wednesday's Fed meeting potentially changes everything. Educate yourself on the difference between paper silver and physical silver. Understand what you actually own if you hold an ETF versus physical coins in a safe. Calculate what percentage of your portfolio is in dollar-denominated paper assets versus hard assets that maintain value during currency crises. And most importantly, stop thinking about silver as just another commodity trading on your screen and start thinking about it as a monetary asset, a form of wealth preservation that has survived every empire's rise and fall for 5,000 years. This isn't about getting rich quick on a commodity trade, though plenty of people will profit handsomely from understanding these dynamics before the crowd does. This is about understanding that the monetary system you grew up trusting, the system that has defined American financial dominance for your entire lifetime, is in the process of fundamental transformation. And in that transformation, the people who move first, who convert paper promises into physical reality, are the ones who preserve their wealth, while others watch their savings evaporate in real time. The crash is coming. The margin hike washout will shake out the weak hands. But the underlying crisis driving capital into silver and gold isn't going away. It's accelerating. And the difference between $110 silver and $150 silver might be measured in months, not years. If this video helped you understand what's really happening behind the price movements and the headlines, if you now see the connections between dollar weakness, Fed independence, Chinese export policy, and your own financial future, do me a favor, share this with someone who needs to hear it. Your family members watching their retirement accounts, your friends asking why everything costs more, your colleagues wondering if their savings are safe. They need this information. The mainstream media won't explain these connections because they're either too ignorant of the mechanics or too invested in maintaining confidence in the existing system. Hit that subscribe button and turn on notifications, because what happens this Wednesday at the Fed could be the moment we look back on as the beginning of the real crisis, not just the preview. I'll be covering it in real time, showing you exactly how to interpret the market's reaction and what it means for your next move. And drop a comment below. Are you positioned for what's coming, or are you still holding paper, hoping the system holds together? I want to hear where you are in your preparation journey, because we're all navigating this together. The elites in Washington and on Wall Street don't want us comparing notes and learning from each other, but that's exactly what we need to do. The next 48 hours could define the next 48 months of your financial life. Don't face it unprepared. I'll see you in the comments, and I'll see you Wednesday when the Fed shows us exactly how much independence they have left.